Hi, everyone. Welcome to our strategic performance review of the SCG Group for the 2025 fiscal year. This report, titled Strategic Transformation and 2025 Financial Performance Review, has been prepared by HDIN Research. We will focus on how the group is navigating cyclical industry troughs through high value-added HVA acceleration and regional production optimization. Our discussion today is structured into four main pillars. First, we will contextualize the current performance within the broader macro environment. Second, we will dive deep into the specific operational realities of SCG chemicals, cements, and packaging. Third, we will look ahead at the strategic roadmap, particularly the Vietnam expansion. Finally, we will conclude with an outlook for 2026. Setting the scene, the 9-month period of 2025 was characterized by significant macro headwinds. We observe rising trade protectionism in key markets like India and Indonesia, alongside oil price volatility. Domestically, the Thai economy remains sluggish with a downward GDP revision to 2.2%, primarily driven by a weak residential construction sector and Thai baht appreciation affecting export competitiveness. Moving to the financials, despite the top-line revenue facing pressure from packaging price compression, we see a resilient EBITDA of 44.5 billion megabytes, up 15% year-on-year. This reflects the group's aggressive efficiency gains. Crucially, the net debt-to-EBITDA ratio has improved significantly to 4.7x, signaling a strengthened balance sheet despite the challenging environment. However, the complication lies in the third quarter. SCG reported a net loss of 669 million megabytes in Q3 2025. This was a confluence of inventory losses in the chemicals segment and the heavy fixed cost load, specifically depreciation and interest, as the Long Son petrochemicals project in Vietnam transitions into its operational phase. To counter commodity price volatility, SCG Chemicals is pivoting aggressively toward high value-added products. We are pleased to report that HVA now constitutes 60% of the downstream portfolio. Innovations like SMX technology and advanced recycling solutions are providing the necessary margin buffers in an otherwise depressed chemical cycle. In the cement segment, the strategy is clear: lead the low-carbon transition. The launch of the Low-Carbon Cement Generation 3, LC3, is a strategic milestone, achieving a 30% reduction in CO2. While residential demand is soft, infrastructure projects remain the primary volume driver, and SCG is leveraging Vietnam as a hub for green exports to high-growth markets. SCG Packaging demonstrates consumer-side resilience. Despite regional price compression, sales volume grew by 3%. The recent acquisition of PT Prokimas in Indonesia is a testament to the group's strategy of deepening fiber packaging networks across ASEAN, ensuring that COGS remains disciplined at 82% of sales. A standout performer is SCG Cleanergy. With over 400 megawatts currently operational and an equal amount in the pipeline, Cleanergy is no longer a peripheral venture, but a core business unit. Their success in grid modernization and heat battery technology positions them at the forefront of industrial decarbonization. Perhaps the most critical strategic lever for the next 24 months is the LSP ethane project in Vietnam. By investing roughly $500 million to increase feedstock flexibility, SCG can utilize ethane, which is significantly cheaper than naphtha. This move is designed to maximize margins in the high-growth Vietnamese market. On the digital front, Smart Living is driving internal cost structure optimization. By implementing AI-driven damage detection and re-roofing measurements, quotation cycles have been slashed by 66%. This digital lean automation approach is essential to maintaining margins in a contracting Thai building materials market. SCG Chemicals holds a distinct advantage in HVA mix and ESG premiums compared to regional peers. While competitors may have larger scale, SCG's operational flexibility and rapid adoption of green polymer R&D provide a high barrier to entry and future-proof the segment against carbon pricing. Similarly, in the cement and green solutions space, SCG's platform dominance is underpinned by its logistics network and digital service integration. Their low carbon percent is significantly higher than the industry average, allowing them to capture niche market premiums in green infrastructure. SCG's commitment to ESG is quantifiable. We are seeing a steady trajectory toward the 2030 target of a 25% reduction in Scope 1 and 2 emissions. This is being achieved through a mix of renewable energy scaling, CCUS exploration, and the implementation of best available technology across all plants. Financial discipline remains the group's North Star. The reduction of the net debt/EBITDA ratio from 6.3x to 4.7x is a significant achievement. By optimizing working capital and reducing high-interest debt, the group has secured a firm liquidity position with over 50 billion megabytes of cash on hand. In summary, the 2026 outlook requires a balanced approach: short-term financial discipline to weather the current cycle, mid-term transformation through HVA and green products, and long-term growth anchored by the Vietnam LSPE project. The management action plan is focused on divesting non-core assets and maximizing operational agility. This concludes our formal presentation. We now open the floor for any questions. Should you require a more granular market research report or deep dive data, please reach out to HDIN Research at sales@hdinresearch.com. For your reference in the appendix, the geographic sales mix highlights a heavy 82% concentration within the ASEAN region. Notably, the China and Taiwan markets combined account for 6% of our export destination, serving as a unified and critical industrial partner for the group. Slide 19 provides the raw data for segment performance. You will notice that while chemicals and smart living faced double-digit contractions due to cyclical and domestic factors, cement and green solutions saw a 23% EBITDA jump, driven by energy transition efficiencies. Finally, we outline the roadmap for our corporate structure. Following the successful listings of SCGP and SCGD, the next milestone is the optimization of the SCGC listing once market conditions normalize, alongside the continued scaling of the Cleanergy portfolio.